Hello there and welcome to this video on overnight index swaps. We will discuss the basics, take an example to understand the calculations. We will try to understand why overnight index swaps are used. So let's get going. An overnight index swap, or OIS, is a derivative contract. It is an interest rate derivative contract that allows two parties to exchange a fixed interest rate for a floating interest rate based on a notional amount. The floating rate is based on a daily overnight reference rate. The reference rate is a daily overnight reference rate. This is the main differentiator of OIS. The overnight reference rate can be SOFR in USD, SONIA in GBP, or SORA in Singapore dollars. No principal is normally exchanged. At maturity, only the difference between the fixed and the floating interest amounts is paid or netted. Since the floating rate changes every single day, OIS cash flow calculations require daily compounding to determine the net payout. This is the main distinguishing point of overnight index swaps. Remember, in fixed to floating plain vanilla IRS or interest rate swaps, the floating rate is usually not an overnight rate, but a rate for a longer period, and compounding is usually not done. Basically, the calculation of the floating leg in an overnight index swap is a bit complicated because of daily compounding. You can think of it as the notional principal amount being invested at the overnight rate on day one, where it will earn the relevant overnight interest. The principal plus the interest on day one will form the principal for the next day, day two, and this revised principal will earn the overnight rate for day two, and so on. At the end of the term of the OIS, the value of the total interest earned will be the floating leg receipt. We need to subtract the fixed rate payment from this total floating rate receipt to know whether a net payment is receivable or payable. The floating rate factor for a period is calculated based on the following formula. Looks a little complicated, but we'll understand this once we get to the calculations in the example. RI, this formula, is the overnight rate for DI. DI is the number of days that the rate applies, usually 1, because it is an overnight rate, but it is more for weekends or holidays. It could be 2 or 3. For example, for Fridays, it is 3. D is the day count convention, usually 360 or 365. And N is the total number of business days in the period. The figures for I is equal to 1, 2, 3, and so on, that is day 1, day 2, day 3, and so on, are multiplied, not added. You can see this symbol. This indicates that there is a multiplication, not addition. These figures are multiplied because we are compounding. Let's say we have a 1-week overnight index swap contract with a notional of 10 million and a fixed rate of 5%. The duration is 1 week, just 7 calendar days, Monday to Sunday, with 5 business days. Day count is actual 360. Actual number of days will be divided by 360 instead of 365 or 366. Suppose the daily overnight rates, let's say we are taking the reference of SOFR, for the 5 business days are Monday 5.05%, Tuesday 5.07%, Wednesday 5.1%, Thursday 5.08%, and Friday 5.05%, which is applied for 3 days because of the weekend. All these rates are annual rates. Floating rate interest factor calculation based on the formula is as follows. 1 plus 5.05%, which is the rate for Monday, into 1 divided by 360. This figure is multiplied by 1 plus 5.07% into 1 by 360. Again, this figure is multiplied by 1 plus 5.1% into 1 divided by 360, 1 plus 5.08 divided by 360, and 1 plus 5.05% into 3 divided by 360. This is the rate for Friday. From this, 1 is subtracted to get the interest rate factor for our product. Note that the interest rate on Friday is applied for 3 days, that is Friday, Saturday, and Sunday. Therefore, the interest rate sum in US dollars is when you multiply this floating rate interest factor by the notional amount, which is 10 million. This comes to 9851 US dollars. This is to be received by the investor. Now, the fixed rate interest calculation, which has to be paid by the fixed rate payer, is 10 million into 5% divided by 360 into 7. which is US dollars 9,722. Note that the fixed rate is not compounded over the 7 days. The net settlement. Since the floating leg is 9851, which is greater than the fixed leg 9722, the fixed rate payer receives the difference of US dollars 129. This is his earning because the fixed rate payment is less than the floating leg receipt, which is got by the fixed rate payer. Now, who uses overnight index swaps? Banks and companies used overnight index swaps to lock their interest rates for managing the interest rate risk. This protects them from adverse movements in interest rates. Investors also use this strategy to profit if they think the rates are about to change. Hence, overnight index swaps can be used for hedging and for speculation. This brings us to the end of our video on overnight index swaps. Thanks for watching and happy learning.